If you're watching this video right now, there's something happening in the global financial system that should terrify you, and I'm not being dramatic. Gold just shattered $4,000 per ounce. The US dollar is experiencing its worst 6-month decline in half a century. And for the first time since World War II, America's closest allies are quietly preparing for a world where the dollar isn't king. This isn't a conspiracy theory. This is happening right now. And by the end of this video, you'll understand exactly what it means for your savings, your retirement, and your financial future. Let's dive in. Here's what most financial news won't tell you straight. The gold rally we're witnessing isn't just another market trend, it's a warning signal. Think of gold as the financial world's smoke detector, and right now, it's screaming. In October alone, gold extended a rally that's been building since 2023, with no signs of stopping. Silver hit its highest price in over 40 years. Chinese mining giant Zijin Gold raised $3.2 billion in one of the year's biggest IPOs. Everyone wants a piece of precious metals. But here's the thing that should keep you up at night. Throughout modern financial history, there's been a playbook for crisis. Economic turbulence hits, and investors rush to two things: US dollars and US Treasury bonds. That playbook just got thrown out the window. Now they're rushing to gold instead. One market analyst put it perfectly. What we're seeing at the moment is not like anything really that we've seen over the last couple of decades. That's not hype. That's fear. Gold has always been humanity's ultimate insurance policy. It's been around for over 5,000 years, survived every empire's collapse, every currency's debasement, every financial panic in human history. Unlike a stock certificate or a government bond, gold doesn't depend on anyone's promise. It just exists, rare and valuable, regardless of what's happening in Washington or Wall Street. Let me take you back through recent history, because gold has been trying to tell us something for 25 years. In the year 2000, gold was trading around $280 per ounce. Most investors ignored it. The dot-com bubble was raging. Everyone was getting rich on tech stocks. Then came the crash. By 2008, during the global financial crisis when Lehman Brothers collapsed and the world's banking system nearly imploded, gold broke $1,000 for the first time. Fast forward to 2020, COVID-19 hits. Governments print trillions of dollars, and gold smashes through $2,000. That was our second warning. Now here's where it gets really interesting. In 2025, after the Trump administration's aggressive tariff announcements, gold obliterated the $3,000 barrier and kept climbing. Each threshold represents the same thing: a loss of faith. Faith in institutions, faith in government stability, faith in the dollar itself. Here's a stat that should concern every American. Gold has outperformed equities, bonds, and almost every other asset class since 2000. That's not supposed to happen in a healthy, growing economy. Gold typically only dominates when traditional investments are failing. It's the one asset that surges when everything else in your portfolio tanks. Now let's talk about what's really driving this crisis: the death of dollar dominance. For over 70 years, since the Bretton Woods Agreement after World War II, the US dollar has been the world's reserve currency. Want to buy oil from Saudi Arabia? Use dollars. Want to trade with China? Settle in dollars. The dollar sat at the center of global commerce like the sun at the center of the solar system. In the year 2000, the dollar made up nearly 75% of the world's foreign exchange reserves. Countries around the globe hoarded dollars because they trusted America. They trusted our government, our institutions, our Federal Reserve. That trust is evaporating. Today, the dollar's share of global reserves has been steadily declining. And this past summer, the dollar hit its weakest level in more than 3 years. What's happening is called the debasement trade. Investors are betting that faith in the dollar is fundamentally broken, so they're rotating into assets that can't be devalued by government decisions. Gold is the obvious choice because it has no counterparty risk. It's just you and your gold bar. No government can print more of it. No central bank can manipulate its supply. No politician can tweet it into oblivion. But here's the critical question. Why now? Why is trust collapsing in 2025? There are 3 seismic events that shattered global confidence in the dollar system. First, Russia's invasion of Ukraine in 2022. When Russian tanks rolled into Ukraine, the G7 countries froze Russia's central bank assets held in Europe. Billions of dollars simply locked. Now, you might think that's justified, and maybe it is. But here's what happened next. Every other country on Earth looked at that action and thought, if we ever anger the United States, they could do that to us too. China started thinking about this. India started thinking about this. Saudi Arabia, Brazil, Poland, the Czech Republic, they all started thinking about this. The solution? Buy gold. Diversify away from dollar assets. Reduce dependence on a system that could be weaponized against you. Central banks that were selling hundreds of tons of gold per year in the early 2000s are now buying about 1,000 tons annually. That's a complete reversal. Second trigger. The Federal Reserve's independence is under unprecedented attack. For decades, the Fed operated as a politically neutral institution, making monetary policy decisions based purely on economic data. Not anymore. President Trump has publicly pressured the Fed to cut interest rates, even floating the idea of appointing himself to the Federal Reserve Board. When the central bank loses credibility, when markets believe political pressure influences monetary policy, the entire foundation of currency stability crumbles. Lower interest rates make gold more attractive because gold doesn't pay interest. But here's the catch-22. If the Fed resists cutting rates, inflation stays high, which also makes gold attractive as an inflation hedge. It's heads gold wins, tails gold wins. Third trigger. Tariffs and trade chaos. The Trump administration's aggressive tariff policies have created unprecedented uncertainty in global trade. When you slap massive tariffs on your trading partners, they start asking a very dangerous question. Why are we conducting all this trade in dollars? Why are we enriching American financial systems while being punished with tariffs? Alternatives suddenly look very appealing. Now let's talk about the elephant in the room. China. This gold rally is fundamentally a China story. China is the world's largest gold consumer. It's the largest gold producer. And the People's Bank of China has been one of the most aggressive buyers of gold over the past several years. This isn't random, it's strategy. China wants to create a world less dependent on the dollar. For decades, even China's own exports have been settled in dollars rather than yuan. That's an enormous source of American financial power. But if China can position gold as an alternative reserve asset, if it can encourage other nations to hold gold instead of dollars, the entire architecture of American economic dominance starts to crack. China's been systematically reducing its holdings of U.S. Treasury bonds and replacing them with gold. Other nations are watching and following suit. This is the most significant shift in the global monetary system since Bretton Woods. So here's the question you probably shouting at your screen. What should I actually do with my money? Let's be practical. First, understand that portfolio allocation matters more than ever. The old 60 to 40 stock bond portfolio is dead. Bonds used to be your safe haven, but when you can't trust the currency those bonds are denominated in, they're not safe anymore. Consider allocating 5 to 10% of your portfolio to physical gold or gold-backed ETFs. Not as a speculation, but as insurance. Gold-backed exchange-traded funds saw their biggest monthly inflows in over 3 years this past September, 6 times larger than rate-based models predicted. That's institutional money recognizing the paradigm shift. But don't stop at gold. Silver and platinum have actually rallied more than gold this year because they have industrial applications. Silver is critical for solar panels and electronics. Platinum is essential for catalytic converters and hydrogen fuel cells. These metals give you precious metal exposure plus real-world demand fundamentals. Here's something most financial advisors won't tell you. Consider international diversification beyond traditional markets. Look at assets denominated in currencies from countries with strong fiscal positions. Switzerland, Singapore, Norway. These nations have lower debt-to-GDP ratios and more conservative fiscal policies than the United States. Some investors are also looking at Bitcoin and cryptocurrencies as digital gold. There's a legitimate argument that Bitcoin serves a similar function, an asset outside government control that can't be printed or debased. But cryptocurrencies come with extreme volatility and regulatory uncertainty. They're not for everyone. Now let's play devil's advocate because you need to hear both sides. Not everyone believes currencies and bonds are easily replaceable. The dollar still represents roughly 60% of global reserves. The U.S. economy remains the world's largest and most innovative. American financial markets are the deepest and most liquid on Earth. If President Trump de-escalates his tariff policies, if a Russia-Ukraine peace deal emerges, if geopolitical tensions ease, gold could see a significant correction. Volatility is written into gold's fine print. There have been periods where gold has declined 30 to 40% in a matter of months. If you're buying gold at $4,000 an ounce, you need to be prepared for that possibility. Goldman Sachs and Deutsche Bank both predict gold will continue rising in the near term, but Wall Street isn't infallible. They've been wrong before. They'll be wrong again.